Really, we've got three big topics that I thought we'd share with you this morning. First off is the idea that what we see in the marketplace today is a gap. We call it a valuation gap, and I want to talk to you about that a little bit. The second is share with you some of the, just kind of a framework for looking at companies to begin to drill down on how do you think about improving the value of companies, and then kind of going into what are some of those levers, some of the things we talk about in the little book, what are some of those value drivers and levers that maybe either as business owners or advisors to business or lenders or investors, things that may help those companies. So that's kind of the outline for this morning. So I'd like to jump in and talk to you a little bit about this idea that there's a value gap. On the left-hand side of this screen, we probably all know this, but there's millions of small companies that tend to be below $1 million in revenue. As you transition up, obviously you have several thousand large publicly traded companies, and in the middle is where the large volume, and it's really interesting that probably half our GDP comes out of the middle market businesses. Our framework, it's a very simple framework we've used for years, and to look at companies is based on really trying to get alignment around 5 key areas in a business. We lead with the strategic health of a company, and then we end up with how do you finance it. It may be obvious, but why do we care about this? Because what we're trying to do is identify and be proactive in preparing for kind of the next stage of the company, no matter what that next step is. All right, well, let's try to move to real value drivers and maybe end up with some things that you can really do or begin to act on to make a difference. And so the first one is this one, which is talking about it from a macro industry level. This is a chart that was created by McKinsey. On the y-axis, you have effectively the types of deals. These are M&A deals relative to company size. So the top left is large company merging or buying large company. The bottom left is large company buying small company. And then along the bottom, along the x-axis, left side is the lower value, which tends to be based on cost synergies or cost savings. And the right side is your higher values, and it's based on long-term strategic top-line synergies. Does the company have the foundation in place to get to the next stage, to do what it's wanting to do? So let's talk about that for just a minute. I'm not going to go through them all, but I want to give you just a couple of highlights. One of those is the customer base. This one is always interesting with clients to talk about, is the idea that what's your ideal customer base based on that growth strategy, and how many of your existing customers fit that ideal customer base? Another one is, that'll hit home here for many of us that do the financing side, is how do we tighten the operating cycle? Basically, how do we operate the business with less working capital? And then if you think about reducing risk, I'm not sure what your experiences are, but ours are, there's kind of 3 areas, I would say, in lower middle market companies. Number one is customer concentration. We bump into customer concentration issues all the time, and that's a detractor in itself from value. Relationship concentration is a second one. It's where the CEO or the owner of the business has all the key relationships and has not really pushed that into his team. And then third is supplier concentration. You have kind of the reverse problem, but you see where you're critically dependent on a particular supplier, trying to find ways to mitigate that. And there's lots of different strategies. And so what we're trying to do, if I had to begin to try to sum this up, we're trying to shift the discussion with an investor or a buyer or a lender from a historical trailing 12 months adjusted EBITDA. And we're going to, by the way, you're always going to have that. But we're trying to shift the conversation from that historical perspective to a future-looking perspective. So try to wrap up a little bit, just kind of some key points here, if you will, for takeaways. Just think about those fundamentals and try to frame. One of the things we're trying to do is I've thrown a bunch of stuff at you to think about. The key is sorting through and figuring out what I call the real levers. It's the ones that can really have an impact on the realizable value and that you can focus on. So I think being able to demonstrate performance is kind of a second big concept here, is being able to talk about a strategy or talk about a growth plan is nice, but demonstration and execution is where you can actually see the value show up in a transaction. And then kind of keeping in mind this core concept, I go back to it, there's all kinds of valuation metrics for different companies, but at the end of the day, it really all boils down to long-term future cash flow. So that tends to be how we see the world.